While the S&P 500 Index Fund lets you invest in the strongest 500 companies in the US, the problem with that is you'll be exposed to geopolitical risks. Like, what if the US goes bankrupt on its debts or is attacked by kaijus? Then your US investments all gone case law? That's why if you want more diversification, you can check out the All World Index Fund, which lets you invest in 1,000 stocks to over 10,000 stocks from the entire world. Basically, diversification gao gao. In this video, I'll do a quick comparison on some of the most popular all-world index funds, such as where are they listed, what are their expense ratio, and most importantly, which is the best all-world fund for investing via cash, CPF OA and SRS. As a bonus, I've compiled all this info into this super detailed spreadsheet, which you can download for free, link down below, yeah? Alright, the first thing you need to know is that the investable world is split to 3 different classifications. First, you have the developed markets, where there's a high growth rate, better developments, and good life standards. The emerging markets, where there's slower growth rates, slower development, and lower life standards. Then there's also the frontier markets, which are less established than emerging markets because they are either too small, carry too much risk, or are too illiquid. But for the purpose of this video, we will only be looking at the developed and emerging markets. Here, countries that are highlighted in blue are the developed markets, such as Canada, USA, and yes, even Singapore. While on the other hand, countries that are highlighted in green are the emerging markets, such as China, Brazil, and India. Now, even though there are many all-world indexes out there, in reality, each of them may be tracking different things. For example, we have all-country world indexes that track small, mid, and large cap stocks from both the developed markets and the emerging markets. Then, we have the all-world indexes that leave the small cap stocks out. Then, there's also world indexes that leave the emerging market and small cap stocks out. So then, which is better? Unfortunately, there is no easy way to tell because there isn't a clear winner here. For example, the developed and emerging markets have each taken turns outperforming each other in the past. Same for stocks from different market caps, where either one can outperform each other depending on different market conditions. That's why you don't have to worry too much about the holdings, because as you can see, even if the emerging markets are included, it only takes out about 8 to 10% of the weightage, which is rather small. Same for the small cap stocks, where the weightage is also very small. So if you look at my list here, you will see that different funds track different markets as well as stocks from different market cap. And if you compare their performance, most of them would give you around the same returns. Also, another thing that you will notice is that there are indexes from MSCI and there are indexes from FTSE. What are they? And what are the differences? To put it simply, they are basically different index providers. The biggest difference between them is how they count certain countries as developed or emerging markets. For example, MSCI classifies South Korea as an emerging market, whereas FTSE classifies it as a developed market. But again, there's nothing much to be worried about, as they are basically almost the same. Then you'll be like,
Aya, just tell me which is the best fund I should invest in lah.
Okay. Let's first start with the best fund you should go for if you are investing with cash. If you are someone from the United States, you should definitely go for the Vanguard Total World Stock ETF. Ticker symbol VT. That's because it has the lowest expense ratio at 0.07% and highest net assets, which makes it the popular choice among investors. Plus, it has over 1.2 million average trading volume, so the bid-ask spread that you get will be pretty good. However, if you are not from the US, it's better to avoid VT since it's domiciled in the US, which means there will be a 30% dividend withholding tax. In that case, you will need to go for ETFs that are domiciled in Ireland, where the dividend withholding tax is a little lower at 15%. So among these 5 Ireland domiciled ETFs, which should we go for? One super popular ETF that many people like would definitely be VWRA. However, one of its biggest downsides is that its 0.22% expense ratio isn't exactly cheap. So should we go for the cheaper ETFs then, like ACWD and IMID? Yes. Now, even though their expense ratio is a lot lower, the biggest difference is that they are using the optimized sampling replication method. As compared to VWRA, which is using the physical replication method. Huh? What's that? Basically, in a full physical replication method, the index would just buy up all the securities that make up the index. And on the other hand, the optimization sampling method would just buy the most representative samples to match the index based on correlations, exposure, and risk. While the optimization sampling method is cheaper, the issue with that is that this may lead to bigger tracking errors. For example, VWRA, which uses physical sampling, has a tracking error of about 0.47 basis points. Meanwhile, ACWD, which uses optimized sampling method, has a higher tracking error of 0.74 basis points. So, if you're okay with having a bit of tracking error, then sure, it's okay to go with either of these ETFs, as you get to enjoy a much lower expense ratio. Though, just take note that the downside of ACWD and IMID is that since the average trading volume is very low, you will end up with a wider bid-ask spread, which means you'll be buying and selling at a less optimized price. However, if you absolutely want ETFs that do physical replication, you can also check out the newly launched FWRA ETF, which just came out in June 2023. The good thing about this ETF is that it uses physical replication, which means less tracking error, plus it has a lower 0.15% expense ratio as compared to VWRA 0.22% expense ratio, which means you get to save on more fees. For example, if you invest $100,000 in both VWRA and FWRA with an investment period of 20 years and a 6% annual return, you'll be paying an extra $4,100 in fees, which is rather expensive, yeah? Though, the downside of FWRA is that since it's a rather new ETF, its total net assets of $490 million are a lot lower as compared to VWRA net assets of $28 billion. Though, personally, I wouldn't worry much since this ETF has been growing in size rather well, as it went from $150 million to almost $490 million now. Also, if you are wondering where you can buy Ireland domicile ETFs, the best broker to use would be Interactive Brokers, as it is one of the rare brokers that gives you access to the UK market while charging you a super low $1.70 fee for it. And here's a pro tip: while they charge a $2 currency conversion fee, you can easily bypass this fee by setting up a recurring investment plan, because that way, they'll automatically convert the currency for you and you will avoid paying the $2 currency conversion fee. So if you don't have an IBKR account yet, you can sign up using my link down below, yeah? Next, if you want to invest your CPF OA as well as SRS money into an all-world fund, here are 3 funds which you can choose from. As to which you should go for, the answer is pretty clear. You can just go with the Amundi Index MSCI World Fund, as it charges a super duper low 0.1% expense ratio. However, this fund only invests in the developed market. So, if you also want to invest in the emerging markets, you will need to go for the Dimensional World Equity Fund, which has a slightly higher 0.35% expense ratio. Though, just take note that you can only invest via your SRS money and not CPF OA money, yeah? As to which platform you can use to invest in these funds, your only choice is Endowus via the Fund Smart option. And here's another pro tip. If you have multiple funds that you want to invest in via the Fund Smart portfolio, like maybe you have the Amundi Index MSCI World Fund and the Amundi Prime USA Fund, it's better to create 2 portfolios and put 1 fund in each portfolio. That's because Fund Smart charges 0.4% to 0.6% fee for multi-fund portfolio and 0.3% fee for single fund portfolio. So by separating your funds, you get to save on some fees. Again, I have an exclusive sign-up link to Endowus down below, where you get to enjoy $50 off instead of the usual $20 off, yeah? So that was a quick video on how to invest in the all-world index fund. But if you have any more questions, do join my 10,000 members Telegram chat group to ask any questions that you may have.